executive at Informative Garage. I am very delighted to host you all for today's third session in the series, The Startup Journey, How to Fundraise and Pass Investor Due Diligence. Am I audible? Okay. This session is designed for aspiring entrepreneurs, startup founders, and others who are curious to know about the startup ecosystem. In case if you're here to understand about the fundraising process or to know the behind the scenes of the financial practices such as investor due diligence and valuation, you are in here for a valuable learning experience. Why? Because we are incredibly honored to have with us a speaker who brings both expertise and experience from the heart of the startup and finance world. Now, let's welcome Mr. Soumyadeep Pramanick. Soumyadeep, are you there?
Yeah, thank you so much. Thank you so much for welcoming me. It's a
Yeah.
great honor to be here in this portal, and I would be able to share my experiences through you, and I'm very excited for it.
Now, let me give a small intro about Soumyadeep Pramanik and what we are going to learn in our today's session. So, Soumyadeep is a CA finalist and currently working at Banshi Jain and Associates as an article trainee. And he previously worked with Grant Thornton and brings hands-on experience of statutory audits, valuation, due diligence, and transaction advisory. His deep knowledge about financial reporting and investor due diligence makes him a perfect person to walk with us through this journey of startup fundraising. And alongside his technical knowledge, Soumyadeep has a deep, he's engaging with the evolving of startup ecosystem in India, and his valuable insights will be very useful for both early stage founders and finance professionals. So this next, what you're going to learn in this session: firstly, an overview of startup ecosystem; next, a breakdown of the fundraising process and key insights of investor due diligence; and finally, career opportunities or paths into the startup ecosystem. And at last, we also have a Q&A session. So please stay till the end to answer your questions directly by the experts. And we also have a surprise quiz at the end of the session. And before starting the session, here are quick notes. Please mute yourselves to avoid any background noises. And also, this session is being recorded, and the recording and uh, other presentation papers will be shared through our WhatsApp channel and YouTube channel. So please stay connected to us and please turn on your cameras to make this session engaging and interactive. And once again, thank you for joining us. Now, without any further late, we'll welcome our speaker, Soumyadeep Pramanik. Soumyadeep, over to you.
Thank you so much. Thank you so much. I would just share my screen.
Okay.
Okay, is my screen visible?
Yes, Soumyadeep, your screen is visible, but we can't see your face.
So I am just connected with another phone. I
Okay.
think, yeah.
Okay.
Okay, thank you. Hello everyone, thank you so much for having me. So this session would be a very insightful and technical session. So let's get ready to understand the overall startup ecosystem, how a startup actually ventures into the ecosystem and then gets into the overall fundraise process. And not only that, we'd also understand how the practical things work, because in YouTube, news, media, you get to learn about vague terms. You learn about so many things that are actually not so practical, but here in this webinar you would be getting insight of all this. So let's get into this wonderful voyage. A just short disclaimer that all the opinion and information that I will give through this webinar would be completely for educational purpose. So, of course, do your own due diligence before you take any decisions further. So, what would be our checkpoints? Basically, we would understand the ecosystem first. Who are the stakeholders? Who are involved in this whole machinery? Then we would understand the fundraise system, how a startup understands its position and then enters into the process of fundraising. Fundraising is not a cakewalk, right? It is something very complicated. First, you have to have some valuation benchmark done, and then after an investor gets interested in your startup, due diligence process starts. So we'd also explore how this due diligence work, and we'd also understand how valuation process is undergone. And last but not the least, we would understand what is the future outlook of the ecosystem. Now let's understand the overview of this ecosystem. As you can see in the screen, India stands to be the third largest in terms of startup in the world. Startup ecosystem does not mean only company, right? Of course, they are the parts and parcel of this ecosystem, but other users, other stakeholders like incubators, accelerators, trainers, investors, government, all these participants are actually the part and parcel of this ecosystem to make it completed and make it work properly. And another stats is that it is also third most active incubation and acceleration program, right? If I talk about the data from 2014 to 2024, about $151 billion has been infused in this ecosystem. There are about 875 plus incubators. Incubators means trainers, accelerators who help the new companies to grow. If we talk about number of unicorn startups, as per the latest data, it's about 118. And as per the DPIIT records, there are about 1,70,000 plus startups in India. Now let us understand few insight. Currently, the good picture says that India is one of the largest global capacity centers. Global capacity centers means research is going on, development is going on, new ideas are being generated. So which is a very good news for us. You can see there are many serial entrepreneurs who are not only building the unicorns, but getting one more step ahead, building more and more unicorns in this industry. If we talk about which sectors are getting the most investments, you can see sectors like fintech, consumer services, enterprises tech, they are thriving so much. Here you can get an idea that India is not only talking about the sectors like delivery or only FMCG, but also it is doing good in the fintech services and enterprise tech, deep tech. Another data that I would like to keep in front of you, rise of India's unicorn club. Even in 2024, from the startup ecosystem, there are about 6 companies who became unicorns. Now, is it only the rosy picture? I don't think so, because there are many bad pictures too. If I talk about the intellectual property rights, how many companies hold actual patents? How many companies hold actual original idea to develop a startup? You can see there are only out of 117 unicorns, 101 have only no patents. Means only 16 companies are there who which have their own intellectual property rights. 5,000 plus startups had shut down in 2024, and the list is never ending. But if I talk about both the good picture and bad picture, there is a better picture too, that we are we cannot be stopped. We are unstoppable because India as a country has its benefit of having the largest population in the world and the largest youth population in the world. So developing idea with proper execution can generate more and more productivity in this ecosystem. After we understand about this whole ecosystem, let us go to the technical part. As we understand, entrepreneurship, it is a generic terminology, but startup is a little bit technical. Now, what is called a startup? Now, what is called a startup? So basically, in order to get the status of a startup, you have to get registered under the DPIIT segment. DPIIT registration means what are the criteria you have to follow, that you have to keep in mind. Then only you can get the DPIIT registration. First, your turnover should be less than 100 crore. You have to either get registered as company or LLP or firm, partnership firm. And it has to be a newly formed company. It cannot be like a old company being restructured as new company. And from its incorporation, it has to be maximum 10 years of old. If and only if you are having all these checklists ticked, then only you can get the DPIIT registration. What benefits you get? You would be eligible for 80 IAC exemption. Now, what is 80 IAC exemption? I would be coming later. You would be getting entry to many government schemes, and also you would be getting many free credits and incentives from both government and private organizations. Now, once you get this DPIIT registration, you can now apply for your 80 IAC exemption. For getting this 80 IAC exemption, you have to be incorporated as private company or LLP. Means if you are being incorporated as firm, although you get the startup registration, you won't be getting the 80 IAC exemption. So if you have already got the DPIIT registration as firm, you have to convert yourself either as LLP or as private company. Now this entity should be formed post 1st April 2016. You have to give a self-declaration in Form 1, and you have to register as, you have to apply in IMB, and IMB will approve you. But the thing is that, as you have seen, the number of startup is more than 1,70,000. 80 IAC exemption has been received by only 3,609 startups as per the latest data. Why is it so? Because the startups which are applying, they are not so much lucrative in terms of productivity, not so lucrative in terms of the government promoting them, because they do not have proper intellectual property or they do not have proper vision, so that by getting these exemptions they can thrive more. So more and more startups with better ideations and better formal approach can get the assertion of the government in order to get these benefits. Now, what benefits you get if you have this 80 IC exemption? This is very lucrative, you know. First, you get tax holiday. That means you don't have to pay any tax on your PGBP, means your business income, for any 3 consecutive year in span of the 10 years from your incorporation date. Second, you would be getting ESOP expense deferment. Now, I will talk about this in detail when I will talk about the benefits later. Then it will get set up of losses and carry forward of losses, which is not so lucrative in normal company. And then capital gain exemption in certain aspect. I will talk about these benefits in detail in later part of my webinar. Now, what is the process of DPIIT registration done? Now, DPIIT registration is a very simplified digital process. You, as a startup founder or a student, also can register a company as a startup in the DPIIT portal. So, first of all, you have to register yourself in the startupindia.gov.in. Then you have to apply. Of course, you have to give some details, right? You have to submit a write-up about your business, what your business does, what is your USP, and there is a predefined questionnaire that would be filled by you. and you have to submit it through the online application process along with the pitch deck, and then the department will review, and this can be done in a span of 2-3 weeks. So I would just show you a glance of pitch deck requirement by DPIIT. I hope the screen is visible. So this is the DPIIT guideline by the Startup India. So here you can understand the structure of a pitch deck, what it should consist of. First, you have to have a cover slide. Then you have to have the team information. Then your business model, the size of market, what market opportunity it has, current traction, your competitive landscape. Competitive landscape means in which competitive segment you lie, what is your market share, and what is your vision to acquire market share. Then financial projections and the current financial position, and what you will do with the help of fund you are willing to raise, current equity structure, fundraising history if you have done any fundraise earlier, and the exit option, what you offer to your current investor. So this is the overall idea of a pitch deck, how it should look. Next, coming to the 80 IC exemption, the most lucrative aspect of being a startup. So for 80 IC exemption, you have to be a company or LLP. Then for the conditions that you meet, you have to declare it in Form 1. Now there is a catch, your paid up share capital would be less than equals to 25 crore. And from 1st April 2016, you have to be max to max 10 years old, and you should not be formed by splitting up or reconstruction. That means you have to be a completely new entity. And fifth condition is that you should not be invested in areas in the negative list given by the 80 ISC exemption criteria. First, land and building other than renting, or if you are doing the business of land and building. So you cannot invest in land and building, you cannot invest in loans and advances, you cannot do capital contribution to entity. That means you cannot have any subsidiary company. You cannot do investment in shares and securities. You cannot do investment in vehicle value more than 10 lakh, and no investment should be there in jewelry. Now, if you are doing business of jewelry, then it is okay. Or if you are doing business of selling vehicles, then it is okay. So there should not be any investment in such assets that I have mentioned in your balance sheet, tangible assets. Now, as we understand this fourth point, that it should not be formed by splitting up or reconstruction, in order to clarify more doubts, we have a revised guideline. So based on the revised guideline, we can understand that if the entity is formed due to merger, demerger, acquisition, amalgamation, or absorption, then it will not be allowed. If it is a merger of two or more startup, one or more startup with one or more small company, then also it is not allowed. If it is done through compromise or arrangement, not allowed. But if it is a conversion from LLP to company, then it is allowed. Now, as I've already mentioned, if the company is having a subsidiary company, then also it is not allowed. Now, if there is some regulatory changes, for example, the entity has changed its name, or it has changed its CCIN due to change in state or change in industry, or sole proprietorship has converted into LLP or company, then it is allowed, then no problem. Okay. Now let us understand the benefits to startups. Now, if you understand the benefits properly, then you can understand why it is necessary to be aware about startups and its ecosystem, because there are so many benefits available in multiple regulations. Okay. So first, let us talk about the Companies Act. If I talk about the Companies Act, then a startup is exempted from preparing cash flow statement in its annual report. The second benefit is a normal company has to hold 4 board meetings per year, but a startup has been exempted, it can hold 2 meetings. Third, it can take deposit from its members. Normal companies are prohibited to accept deposit from members beyond a certain limit. A startup can issue sweat equity ESOP as a benefit in exchange of the value a promoter brings into a business. For the normal companies, it is prohibited to issue ESOP to the promoters. But as a startup, you can issue ESOP to the promoters. And there is another aspect of fundraise, that is convertible note. What is convertible note? Convertible note is a special instrument which is provided as a benefit to the startup that they can use to raise funds from both resident and non-resident investors, and they are non-debt instrument, non-equity instrument. They have clause related to equity. Means as per the agreement between the investor and the company, if the investor wants to convert it, then they can convert it based on the agreement, based on the clauses written in the agreement, right? So convertible note does not carry any interest, does not have any regulatory complication like debt, external commercial borrowing, FDI, or other equity and debt instruments. But still, you can issue convertible notes to the investors and get funds. And beyond a certain time, when your startup is doing good, or you think that the amount of money raised can be converted into equity, then this convertible note, whatever amount has been provided, can be converted into equity based on the agreed terms. Now, these are the benefits by the Companies Act. If I talk about the FEMA related benefits, you can issue optionally convertible notes to the foreign investor. For ECB, means external commercial guidelines, there are relaxations related to the formalities. There are relaxations on opening of foreign bank account. Then talking about the public procurement norms. Public procurement norms means in order to get ready access to the tenders which are conducted by government and public companies, as a startup you get early access. There is a concept called earnest money deposit that a normal company or normal entity has to give, but for a startup EMD has been exempted while filing government tenders. You would also get exempted from having prior experience or turnovers, right? So there are so many relaxations in order to acquire tenders too, applying for tenders too. With respect to labor and environment laws, you can self-certify 9 labor laws. So the formalities has been reduced to large extent. You can also self-certify many environment laws. Now talking about the current scenario, ESG means environment, social and corporate governance, is a very important thing to consider. There are social audits being done by the company voluntarily. So self-certification for environment laws, if this exemption, this benefit is provided to the startup, it becomes very easy for a startup to eliminate the regulatory hassles. Then coming to the income tax benefit. Now everybody is very fearful to give tax, right? Because we know about the complicated Indian taxation system, that whatever you do, like if you want to earn income, if you want to do expenditure, everywhere you have to give tax. Now it is very important for a company to get the tax exemptions in order to thrive in this ecosystem, because there are so much competition, and in order to face all the challenges that a startup faces, if they face the monetary and taxation challenges also, then it would be a huge problem, right? So let us understand the income tax exemptions too. If you get the 80 IC exemption, first, as I have already mentioned, you get 3 years tax holiday that you can take in any 3 consecutive years, okay, in the span of 10 years. The next benefit is for a normal company, if ESOP has been granted to the employees, whenever the employee exercises the ESOP, then it will be taxable. But for startups especially, this ESOP tax deferment benefit has been given. Now, it will not be taxed when it is exercised. It will be taxed, let me say, in a way that it will be taxed in the time phase whichever is earlier. First, when the shares should be actually sold, or when the employee is leaving that company, and the third time span is 5 years from the date of exercise. Whichever is earlier, then the tax will come into picture. Before that, tax will not come into picture. Okay. So with respect to that, the TDS related thing, the TDS related liabilities also gets benefited for the company. The next one is capital gain exemption. There are two sections. One is 54EE, another is 54GB. What is 54GB? If you have sold a house and then within 1 year, if you invest in a startup which has already had, which has 5 years, as I can see the comment, it would be 5 years from the date of exercise in with respect to ESOP. Okay. Now, as I was talking about the capital gain exemption, 54GB, if you have sold your house before filing of return, if you invest that money into a startup which has already got 80 ISC exemption, then your exemption would be up to 50 lakhs. Okay, so it is in order to promote the startups. Okay, then there is another section called 54EE. If you have sold any long-term capital assets, and then if you invest that amount in any funds which is created by government, your whole capital gain would be exempted. Okay. Coming to the next benefit, setup and carry forward of losses. If there is change in shareholding more than 51% in a company, then you are unable to carry forward your loss. Okay. But for startups, you can do, even if you have 51 change more than 51% of the shareholding in the company. Okay, because as you know, in startups there are requirements of fundraise, there are requirements of dilution. So government has specifically exempted the company from this restriction. There are many IBC, insolvency bankruptcy code related exemptions too. If a company is going into insolvency or it's getting into liquidation, then it would be in a much fast track manner, in a regulation friendly way. For intellectual property rights, government wants that company invest more and more on filing of patents, working on new ideas. Okay, so government has also given many relaxation in order to facilitate the registration of patent. Okay, and there are other services, right? Amazon Web Services credit, Zoho credits. If you are a startup, you can avail these benefits too. There are dedicated startup sales by RBI and Startup India where you can seek help. They will be ready to give you many advantages if you are a startup. So as we complete the benefit section, let us understand the fundraise ecosystem. If we understand the data of 2024, about $13.20 billion has been raised, about 1,255 total number of deals, and of course Mumbai is leading the game. There are also emerging locations. For example, if I talk about Ahmedabad, Chennai, Kochi, Jaipur, Hyderabad, these are the emerging locations that you can look ahead. Now talking about which are the sectors getting much more concentration. If you see this pie chart, you can see areas, segments like fintech, segment like deep tech, and SaaS. They are three of the largest segment of this pie chart. There are other segments like consumer. Then if I talk about health tech, these are also the part of this pie chart, which are getting much more concentration from the funds. There are other sectors also like enterprise tech, EV, gaming. These are also thriving in Indian economy. But this gives a broader picture of how the sector-wise outlook is in India. Now let us understand the funding rounds, how a funding round works. Okay. So if I talk about the funding rounds, first incorporation happens. Okay. Then comes the friends and family round that we call as pre-seed equity. Here, your idea is at prototype stage, proof of concept. Here, there is no much valuation discovery. You need money, you get the money from your friends and family. Then comes the incubators, angel investors. Okay. And these rounds are basically seed round or P-series A round, where instruments like equity, CCPS, CCD are introduced. Then comes venture capital into picture, okay, where the valuation benchmark is already achieved by the earlier investor. Now it is more into the product and service gaining the market share. The founders are diluting their stake and getting the money and investing in so that it can gain more and more market share and get developed. And when it has captured a reasonable stage in the market, then it goes into the private equity. In private equity, normally series B, C, D, all these rounds happen. And equity instruments like CCPAs, venture debt, and collateralized borrowings are used. And further, company goes into IPOs or M&As. So there, the earlier investor can take exit, or the employees can exercise their ESOP, they can sell their ESOP and gain a lot. Now, if I give a very bird eye view of the valuation report when it requests, okay. So during all these rounds, whatever I have mentioned earlier, they undergo multiple form of issue. That can be right issue. Right issue means offering to the existing investor. There can be private placement, means you are offering a new issue to some special already pre-recognized people, and you are offering them once the private placement offer letter is subscribed, you are issuing new shares to them. There can be transfer or divestment too. Transfer means change in the ownership of the equity or debt instruments. Okay, and thereby under multiple regulation, Companies Act, Income Tax Act, and FEMA, you need valuation reports. So valuation is required either for the regulatory purpose or for the value discovery purpose. Now let us talk about the funding instruments. What are the funding instruments? Basically, there are instruments like you have already known: equity, CCPS, convertible instruments, debentures, SAFE means simplified agreement of future equity, then convertible notes that I've already said. There are credit lines, loan, venture debt. So there are multiple kinds of instruments which are available to them based on the requirement, valuation aspect, and the financial position of the company. Company selects which instrument to issue. During the fundraise journey, they can first start with bootstrapping. Bootstrapping means using own money to start a business. Then they can go and ask for money from banks, financial instrument, NBFCs, angel investor, high net worth individuals who are ready to invest money with risk, high risk and high reward. They can go to venture capitals. Even governments have multiple schemes in order to promote your startup. Okay. So as I've already mentioned the valuation requirement, this gives you the bird eye view of why valuation is required. Now let us understand cap table a bit. Okay, how an angel investor can earn a lot. So you see, let us understand this table first, then you can understand this table better. Okay, for example, you are raising a seed round. Okay, so during the seed round, you are raising 1 crore of funding. So your agreed pre-money valuation. Pre-money valuation means whatever the valuation you agree before raising the fund is 9 crore. Okay. So if you are raising 1 crore at 10% of post money valuation, your post money valuation would be 10 crore. Okay. So that you can also add as 9 plus 1, 10 crore. Okay. So your pre-money share, how much? 90,000. Okay. And your price per share is 1,000. Okay. So once you issue, shares in the seed round, okay, number of shares issued becomes 10,000. Okay. And now your price per share becomes reassigned as 1,000. Now this angel investor has invested 1 crore rupees in this business. Okay. Now a series A round happens. In series A round, the pre-money valuation is 17 crore. Okay, this is the agreed terms. The business is doing well, getting revenue, getting more traction, and the investment which has been agreed by the investor and the company is 3 crore. So the post-money valuation is becoming 20 crore. Okay. So what is the percentage? It is 15%, right? So this 1 crore, okay, when I am raising this 3 crore at 15% post money valuation becomes 1.7 crore. That means your investment of 1 crore increases by 70%. And the similar manner, the magic of compounding works, and in series B round, you can get about 920% increase in valuation of your angel investor. Okay, angel investment. So this is the understanding of this whole fundraise system. Why the angel investor take huge amount of risk and fund the businesses without having revenue. Because of this mathematics, their 1 crore of investment becomes 10.2 crore just because it has developed itself or could showcase itself through gaining valuation from series A round investor and series B round investor. So this is all about preparing yourself, developing yourself, and then showcasing yourself to the external world. Now let us talk about the fundraise process. So the fundraise process works in this manner. Okay, first you have to do the planning and presentation. Okay, planning and presentation involves, first you have to have your data room ready. You have to have a management information system. You have to have a projection of your financial statement, like in 5 years or 10 years how my business will be growing. You have to have a CFO or accounts head, because funds is coming, money is coming, huge operation is going on, business is developing or business is increasing. Then your accounts head should be well enough in order to manage all these things. So investor look about whether you have a competent CFO or accounts head. Okay, you have to have your ESOP policy, treasury policy, data policy ready, because if there are complication at the initial level, if there are negligence at initial level, then it would create a huge problem in future. You have to of course have a pitch deck, that is one of the initial requirement, and you have to have all your registrations done, startup registration, ATIC exemptions, and registration to multiple other regulations, income tax, FEMA, companies act, wherever and whichever registrations are necessary. Investor wants your company to be all set already. They don't want all the hassles to be taken further. Okay, when funds is already put in, they don't want to take all the risks. Okay, then if I talk about the fundraise process second part, that in a MIS, what you have to look at. Okay, so I just want to show one MIS. So this is a MIS format for a construction company that I am going to show. So you can see this and all these resources would be getting as part of this webinar takeaway. So this MIS or management information system is maintained in order to get the overview of what your business is currently performing, what is the overall insight, or whether whatever you have said to the investor is actually being done or not. Okay. There are certain KPIs that you can follow up. So these KPIs you have to just calculate, you have to get yourself ready, because whenever you are pitching, you have to know your numbers before you are pitching to the investor. Okay. So let us move ahead. If I talk about the fundraise process and what are the government schemes available, okay, there are multiple government schemes available, and I will also share links of all the schemes and policies that you can look at. There are Startup India Seed Fund scheme, which gives seed fund up to 50 lakh based on proof of concept. Even if you do not have any revenue, if you are pre-revenue, then also this seed fund is given. Recent update about the credit guarantee scheme. The recent update says minimum guarantee about of 10 crore per borrower is being given by the government, and that guarantees of about 75% of your loan amount and 85% of your default amount. And the AGF, that means the annual guarantee fee, that has also been reduced, which was earlier 2% and now reduced to 1%. So you can also get benefits of all these government schemes too. There are multiple portals like Vaskar Community, Mark Portal, where you can get mentorship. You can get access to huge amount of mentors, investors, service providers, and you can get the benefit of it. Okay, so these are the list of multiple government scheme. So as a part of PPT, you can just go through all these schemes and you can take the benefits. Okay. Now, if you talk about the different types of valuation, okay. First is your comparable transaction method. Comparable transaction method talks about when your company is a pre-revenue company. You do not have many traction. In your P&L, there is no profitability. Then how do you value? For example, this Startup India scheme is giving you fund under seed fund scheme. How it will value your company? For this, comparable transaction is present. Okay. Comparable transaction determines your value based on similar transaction that happened. Okay. For example, you are valuing a social media company. You have recently made a social media company, which is only virtual, no physical presence. Okay. How do you value that? First, you have to understand what are the metrics in your business. Okay. Let us take one of the metrics, that is a MAU. MAU means monthly average users in your portal. So first of all, you try to fetch pre-money valuation and then divided by MAU, you get a comparable transaction multiple. Okay. Let's say it is 20 times. Okay. And then you try to fetch the average MAU of the company, that is 1,10,000 users, that you can understand from your current MIS. So that is why MIS maintenance is very important, as I have said. So from your insight, you get 1,10,000 users, you multiply and you get, so here it will be 20. So 22 lakhs would be your pre-money valuation. Okay. So this is a comparable transaction method. Okay. I just want to for 1 minute. Karthikeya, do you have time? Because I also have some Excel sheets where I can give you the practical insight of valuation. So if you can just give me assurance of that. Okay, fine. Coming to the comparable company method. Okay. Under comparable company method, the scenario becomes a little bit different. Here, even if it is a pre-revenue company or a post-revenue company, does not matter. Here you actually talk about the financial metrics. Now in comparable transaction method, you did not have the financial metric. That's why you had technical metrics. But here you have financial metrics like revenue, EBITDA, PBT, profit before tax. Okay. Now you can fetch this information, compare with industry in order to get the understanding of what your value is. Now for this, I have an Excel sheet that I'm going to show you in order to let you know how this process actually works. Okay. So let me show you this. Okay. So for example, a shower, you are a valuer. Okay. A shower company has approached with value discovery engagement that, bro, you have to value this company. Okay. It has given your pitch deck, name the shower company. It is a AI generated image. So this is a tech company just for the purpose of illustration. So the shower company, which is having revenue of about 80 crore in financial year 2024, audited financial, and EBITDA of 20 crore. Okay. Now I have not considered profit, PBT and PAT. Why? Because it is not having PBT. It is having loss. So whatever I have, I would take into consideration as per my valuer's judgment. I have revenue and EBITDA. What are my requirements? I have to understand why the company is approached for value discovery engagement. Let's say the company has come because in order to raise the fund, they will just approach the new investors with a valuation benchmark in mind, that yeah, this company is about 100 crore valuation, this company is about 150 crore valuation, something. Then we have to get data. We have to get data from the company and from the industry. Then we have to validate the data. Okay, whether that data, whatever the company is providing, whatever I'm taking from the industry, whether they are correct or not. Okay, I have to do exhaustive research, and then we have to discuss with the company whether this value is actually correct or as estimated or not, because valuation does not only depend on financial calculation, mathematical calculation, it also depends on your subjective understanding of your company, market, and industry, economy. So you have to go bottom up, top down, in whatsoever manner possible in order to validate your subjective judgment. Okay. So this is the list of company that I have researched. Okay. So from where you can get this data? There are multiple sources like Bloomberg, public website, government website, multiple reports by data collection agencies like Big Fours also provide their reports. Okay. From there you try to generate or collect some information like comparable information like revenue, EBITDA, PBT, PAT, debt, bank, net worth. Okay, funding, whether it has already raised any funding, then we can already have some related information, how much the company has grown from then, or what was the valuation sought at the time of getting that fundraise done. TTM, revenue till funding, means till that date of funding, how much the company has incurred the revenue. So this is one of the most valuable data. Okay, if you don't get this data, you have to take a step back and rely on some other information which is closer to your opinion. Okay, and then you have to do the revised valuation. So under revised valuation, what you will do, you have to compare this information. You have to get the multiple, for example, EV by revenue, enterprise value by EBITDA, and you have to get the average of the valuation based on market multiples. So this is the comparable multiples, and these are the market multiples by different market reports, their own research and study. Based on the market study, your own research, you will finally come at the valuation 184.57 crore. Okay, so if I say the current revenue of the company is about 80 crore, right? So what valuation I achieved? It's about 2.3 times, which is actually good, because you can see as per the RSBA data, RSBA is a research agency, and Kroll is also one of the company which does the research. It is an investment banking also. So it has given the multiples about 1.8. Okay, it again RSB has given about 0.8. So we have reached a point where we can say that this 2.3 is a okay multiple to take it ahead. And this is reasonable. Why? Because this is a early stage. This is a company which is early stage. It has much more potential. It can do a lot better, and we can validate all these points based on our research and market data. Okay, so this is the information that I wanted to present. Okay, let us go to the next DCF method. Now we don't have much time to talk about the DCF method exhaustively, but this is the format how it looks. Okay, where you have to get the value of equity and you can get the value per share. Okay, there are other methods also like venture capital methods, First Chicago method. First Chicago method is a pretty interesting concept. This method I've also used in the working that I have shown in the last Excel file. That whenever you are confused about any valuation method, then you take everything, you define them as worst case, normal case, and best case scenario, and then take a weighted average value of all the methods. Okay, and that is very helpful if you want to give a safe side valuation to a company. And last but not the least is adjusted net asset value method. Adjusted net asset value method is very important in case of transfer of security under FEMA and Income Tax Act. So Rule 11 UA governs this, where it is nothing but simple asset minus liability, where you adjust for fictitious assets, for example deferred revenue expenditure, which are not true asset, then contingent liabilities, revaluation assets, and excess provision if any, and then you find your true net worth, and that is your value. That means whenever you come to a point that I have to get my valuation done, minimum that much amount of valuation you have to imagine inside your mind, that my net worth is something 10 crore, I should get at least 10 crore in exchange of my company if I would like to sell my company to any investor. Okay. There are other methods like with or without method, which is pursued for for sweat equity valuation when you are issuing sweat equity. For ESOP related valuation, you have option pricing model. It is pretty complex. I think we can skip this, but in later webinar or whenever we meet again, we can discuss on this. Pori method is also one of the method in order to give a validation on a value based on the price of recent investment done in the company. Okay. Now let us come to the due diligence aspect of it. What is due diligence? Now your valuation is completely done. You have got your valuation benchmark. Okay. Everyone has agreed. Okay. As you have seen in the startup also, they come with a ask that this much valuation I want to seek. Investor says no, I negotiate on this based on my benefit and your benefit, based on mutual understanding. A valuation is finally reached. Now it is the real time to give money to the business, and giving money to the business is very, it has to be done in a very thoughtful manner. Okay. For this purpose, due diligence is done. It is not audit. Audit is a statutory compliance. Investigation is done only when fraud has happened or potential fraud is expected. But due diligence is done when this kind of transaction happens. For example, merger, acquisition is happening, or investor is putting in money in multiple rounds. Okay. So there are multiple types of due diligence: FDD, TDD, SDD, BDD. Financial due diligence, tax due diligence, secretarial due diligence, and business due diligence, which further dissects into technical due diligence, intellectual property right due diligence, IT due diligence, and so on and so forth. So they are the types of due diligence. Now, what is the process of due diligence? First, as if you are doing the due diligence, okay, you should be either a CA, CMA, advocate, or a professional who have understanding of this aspect. Okay. And as a startup also, you should not get your due diligence done by any random person. You have to go to the professional with previous experience of doing due diligence, right? So when you are doing the due diligence, first of all, you have to sign engagement letter. What is the scope of my due diligence? Okay. The financial period, the type of data I will check, what would be the data I would be given access as a due diligence, as a person who is doing due diligence. Then we send the information requisition list, IRL, to the company. They give the data through a data room. Then reliance letter and non-reliance letter is signed. Reliance letter, whenever we give this report to a third party stating that I have done the due diligence for X investor, now you as Y investor can rely on this report based on a discussion with the X investor. In this tripartite agreement, you can rely on this report and you can take decision whether you are willing to do due diligence or not. Okay. And non-reliance letter is something when it is just for the data purpose, information purpose. Okay. when you are giving this report to an investor stating that do not rely on our report, you just take this report just for the information purpose. And then we define our scope and we start our due diligence. Now, as a part of this webinar takeaway, I'll also give you checklist that I have prepared, customized checklist for startups. Broadly, what we have to have in a FDD report, okay? We have to have the basis or scope of work, okay? We have to have the observation summary, which is the most important segment of the FDD, but this can be only done after you have done the due diligence process completely, okay? You have to give snapshot of how the company is doing financially, how the company is doing, or what is the current status of the company based on what the vision was when the pitch was done. Then comes the conditions precedent and conditions subsequent. Conditions precedent is what preconditions you have to fulfill before the fundraise is being completed or before the fundraise is being initiated. If I want to state it more, properly. And condition subsequent means some conditions has to be fulfilled by the company, okay, that they have to fulfill within a certain pre-agreed time period after the fundraise has been done, SHA or shareholding agreement has been signed. Then you have to give background, business overview, MIS, okay. So in order to give a broad overview, these are the main things that you have to do, and this is all about FDD. In TDD, you have to take care of the income tax, GST, VAT, and customs aspect, whether the company is having any pre-existing liability or not, whether all the compliances are being done properly or not, whether company are having proper workings, reconciliations, and thereby you also summarize all the observations. Last but not the least, in the list of the DDs, structure of SDD, where we deal with labor law, FEMA regulations, okay, MSME Act, environmental law, intellectual property rights, whether all the compliances are being done. If a company, now it is a bonus tip, if a company voluntarily does something for the investor without being said to do so, then it would be much more lucrative for them to get focus of the investor. If 3 companies are there and your company is much more much more ready in terms of regulation, much more ready in terms of financial health, much more healthier in terms of tax and other technical aspects, then you would be selected first, even if the other companies are similar to you or better than you, because the money is their hard-earned money. Nobody wants to put into vague, okay. Coming to the common observation of startups. So these are based on my experience that I have done. I have done, due diligence of 30 plus startups, and while doing so, okay, I have come across multiple observations. Most observations, if I summarize, are due to the negligence of the company, because nothing is impossible if focus and awareness is there. For example, you are listening to this webinar. I cannot complete each and everything in detail, but you are being aware about all these points, that these are present surrounding you, but you were not aware of this. But as now you are aware about all these things, you will go and do, and you will do your own research, right? So like how startups, if they are aware, okay, they can get their checklist already ready, and they can do work on their own and get all the red flags changed into green flags. So I think you can get a broad insight of the observations here, okay. Now we are at the very tail end of this webinar. So what is the structure of the letter of intent or term sheet? So in the whole fundraise process, the investor and the company signs non-definitive, non-binding, means it is not legally binding. Agreement is binding, so term sheet is not legally binding. So they sign a term sheet where multiple clauses are written. Okay, due to lack of time, I am not able to cover all these rights and clauses, but I will be giving you a document where all this information would be will be explained in a very simplified manner. So all these clauses are written, and once you sign the term sheet, and when the fundraise process continues to grow in the positive manner, then you come to a point when SSA, share subscription agreement, is signed. If new issue is being happening, then it is share subscription agreement. If it is a transfer of security, share purchase agreement is signed, and for both of the cases, shareholding agreement, shareholders agreement is signed, where all the rights and obligations of both companies and investors are written. Okay. Now, these are some important terms that you can look at, and these are something that you should be aware of if you are talking about startups or going to investors, like non-competing agreement, non-disclosure agreement. Non-disclosure agreement means you agree to not share any confidential information to the outsider. Okay. Then I would just take few terms like API. API means, in the current scenario, like when technology is at the forefront, then there are modules available that you can use in your business as API to integrate some ready-made tools in your business in order to faster your business process. Okay. If I talk about, I'm at the very end of the webinar, so I'd just like to give a overview of the career scope in the startup ecosystem. So you can have your career built in funds, you can have your career built in startups, valuation, due diligence, transaction advisory, or as individual startup advisor. So there are so many aspects that I've told you. So you can actually build your career in so many fields. And you can see that there are about 43 startups that are going to set to go public in 2025. So we are so happy for that. And 18 future arenas of competition that you can see here that will thrive. Some mentions are like robotics, deep tech, autonomous vehicles, space tech, that are coming into picture. And thank you so much for being such lovely participants. Now I'm ready to get the questions from your end. And of course, thank you again for having me here, and thank you so much, Informative Garage, for giving me this opportunity to speak and share my experience. Thank you so much. Thanks a lot.
Thank you so much, Soumyadeep, for that insightful and thought-provoking session. We are truly appreciate your time and your expertise in this with us today. And I'm sure our audience also has gained a lot of valuable insights from your end. So now we quickly move on to our live Q&A session, which was the most asked by our participants. Our first question is, what inspired you to get involved in the startup ecosystem initially?
Okay, startup actually is not a new thing. It has started from 2016 itself, when Startup India came into being. Actually, I should say it from 2014 only, when Make in India happened. So after that, due to involvement of multiple stakeholders, investors, and everyone, okay, uh, this startup has become a very interesting thing right now. Okay. So I think it as an opportunity. Okay. When I was already doing my articleship in Grand Thornton, I was in audit. Now I'm into startup because I see there are many things we can do as professionals. And even I would like to refer to the audience who are there. Whatever business you are doing, whatever job you are doing, you have a place in this ecosystem. So that is why I came into this field.
And the next question is, what do you think are the biggest myths about fundraising that new founders believe?
Uh, I would talk about three myths. Okay, one is that fundraise is complicated. Fundraise is complex. No, it is not complicated. You have to get to the right person with right proposition. Okay, and you have to get prepared. You cannot just go and vouch your idea, right? So you have to be prepared. Second important thing is that fundraise is the only thing that matters in the business. It does not, because once you get the fund, it is the pressure on you how you utilize that money. Okay, so it is a huge responsibility for the founders in order to properly take decisive decisions how to utilize that money. Third myth, I would say that fundraise is very costly. It is not, because there are multiple government schemes available. So if you go to the right path, right destination, people are there to help you. Government is there with opportunities to help you, but you have to go to the right person.
Okay. Our next question is, how should startup decide between bootstrapping and raising external capital?
Okay, so I would like to give the answer in a way that you have to understand your business first. If you have money, okay, and you think that with this money, I can start my business, because at first no one will believe on your idea until and unless you have proved it, right? Simple, as simple as that. So once you start with some amount of money and prove your idea, then you can raise your fund. You can get much more valuation once you have already proved it. Because if you go right away and raise your equity at the very first time, okay, then you have to dilute huge amount of equity of your own self as a startup founder, and that would be harmful. You will be remaining with very less amount of equity at the end. So at proper point of time, you have to take this decision.
And our next question is, are there any negative effects on a startup if the investors say no to the invest after due diligence process?
Yes, actually, it is sad to say about that, because there is an investor community. Once there is something like any whistleblowing happens, or any bad, there is something bad about the health of the company, then that news will be spreading like fire in the investors community. So there will be a negative impact on them. So it is better to become precautioned and get yourself safe uh, before you go to do the due diligence, enter into the due diligence process.
So, what do you think is currently missing or underdeveloped in India's startup ecosystem?
Uh, I think one that I would like to vouch is research. As our minister, Sir CA Piyush Goyal, has already said that the current startup ecosystem is not talking about the research and development. It is only talking about building delivery guys, and just making business of cupcakes, or food items, ice creams. So it is very important that you have to do, you know like the engineers, the scientists, researchers has to come in this field, and research has to be done. And second, advisory ecosystem is not so great. I think advisory ecosystem has to thrive. People with more knowledge should come into this field and thrive this ecosystem.
Our next question is, what aspects do we need to polish to get articleship in this domain?
Okay, so this is a hard question, I would say, because I also, by luck, got this opportunity. The thing is that now many startup firms in mega cities, they are doing all these things, and it will start to grow. So you have to keep a track. You have to have a friend community, so that you can ask them what is happening, because generally a startup starts this practice if they don't see profitability in this segment, or if they do not have proper competence, they do not proceed ahead with it. So you have to just get the information somehow, and you have to enter into this system. It is all about doing research on your own, practically.
Okay. Our next question is, like, any specific points to be taken care of during due diligence process?
Yeah, so I have like if actually it can be stretched. This webinar can be stretched to 6-7 hours, and I can speak like that. But as time's constraint is there, I could not enter into more detail. But I have, for the benefit of all the lovely people who had already joined this webinar, I have the takeaways where they have the checklists ready, so they can go through that and they can refer. I think they can get clarity on what is required.
So, one question is like, How to do valuation of my startup? Like they gave example also. Like my business is a virtual financial services. I don't have any assets and liabilities since it's a virtual mode and that too service sector, and even I don't have any expenses. I only have sales and my total sales is my profit. How can I value it? That is the question.
Yeah, so as I already covered this question in comparable transaction method, that if you are a pre-revenue company, then you have, if you do not have financial metrics, then how you can value? Of course, you have to take other metrics like technical metrics, like website related info, management information system related info. Okay, how much your order book is. Okay, so based on all these criteria, you have to value a company.
And the last question is, how can student entrepreneurs or first time founders make the most of the startup incubators and accelerators?
Okay. So can you just repeat once again? I just got list of it.
Like, how can student entrepreneurs and or first time startup founders make the most of startup incubators and accelerators?
Okay, so this is the sunrise industry for the students, because students have huge potentials, and they can have a huge time period to take risk or get failed and restart again, right? So students, like, as you know, the Zepto founder, he himself is has started his business when he was 17 years old. So students can actually lead this economy and take India in the global bench. Yeah.
Okay, that's all. Thanks for your